Okay, good afternoon and welcome to ET India Boardroom. On this panel today, we'll be discussing sustaining resurgent and resilient foreign investments. We have a great panel today. Our panelists are Apurva Jain, who's the founder of Coelus Capital, and Madan, the chief economist of the Bank of Baroda. And looking forward to our discussion over the next 45 minutes to an hour. If I could request you, Apurva and Madan, to please introduce yourselves. Apurva?
Yeah, sure. Thanks, Gopal, Madan. Good to be here. So basically, I have been a banker for most of my life, having worked across 5 countries. So my last assignment was in India, where I was regional head of transaction banking and cash management. And late last year, I've moved to Singapore to do a startup. And this startup is basically doing a consulting for banks and also doing investing into startups. So it's an interesting space, and it flows in very well with the topic of our meeting in terms of what can we do to influence the financial flows into India and the region, and what are the benefits associated with it.
Thank you, Apurva. Madan?
Yeah, I'm Madan Sabnavis. I'm an economist by profession. I've been working for around 35 years now. I worked in development banking, commercial banking, engineering, commodity exchange, rating agency, and now back to commercial banking. So I'm working with Bank of Baroda as a chief economist. And my work has always entailed looking at all aspects of the economy, and especially examining everything that's happening in the Indian economy. And this particular subject becomes very important for us because today we are saying that India is one of the most attractive destinations for foreign investment. Yet we see that the flows of both FDI as well as FPI has not been as even or less volatile than what we had expected. So I think that's what really excites me about the subject which we are discussing today.
Great. Thank you both. And my name is Gopal Sarma, a partner with Bain and Company, and have been working with clients in India and globally on new business opportunities, on growth opportunities. And I think as we all are seeing, this is a very exciting time for India and the region. And it's a great time to be talking about the opportunity for capital flows and what are some of the challenges. So with that, Apurva, maybe I can start with you. And while there is a lot of opportunity and there's a lot of, we are living in a capital-rich world. I think one of the concerns increasingly is that capital is no longer being used just as capital, it's also being used as a weapon. As we've seen in recent events in Europe and before that in multiple other geographies, politics is beginning to influence the free movement of capital. Now, do you see that as being more a long-term issue? Do you see that as having an impact into the way capital is moving around the world? We're already seeing a bunch of folks being a little more careful about, say, investing into China than they were 3 to 5 years ago. So maybe I can start with you, Apurva, on that.
Yeah, sure, Gopal. So I would like to break it into multiple parts, Gopal, because on one side, we are looking at capital investment in terms of short-term and in terms of long-term. So what are the returns in short-term perspective, long-term perspective? Then we are looking at the sectors where this investment is going. And then we are looking at geopolitical situation and uncertainty in terms of investment and extraction. So if I break it down and if I look at it, okay, in terms of short-term investments, yes, there's a huge amount of volatility. First, there was COVID, there was the pandemic across, I think it's once in a lifetime kind of a event which has impacted the entire world. And then, of course, I think the Russia-Ukraine war was a bit underplayed in January, February. No one expected it to escalate to the levels. There was a higher degree of escalation, which has led to a number of shortages in terms of commodity with oil price hike, etc., etc. Now, over a period of time, in my mind, what I have seen is that this kind of uncertainty has led to a few factors. One is extraction of investments that had happened. So we have seen an impact in terms of reduction in FDI investment. As we have seen coming into India, there has been a 15% reduction in 2020 as compared to 2019. But from a long-term perspective, there may be opportunities. But coming back to the point that can it be used as a weapon, so to say, I think it has to be a balance in terms of target. That what is the target in terms of which country you are investing in or which sector you are investing in? because it depends on the GDP of the country and the growth of the country. If the country has got vacant growth and there's a huge velocity in terms of opportunity, then yes, FDI investment is definitely very useful and it will lead to growth in the country. But if the country is already at the cusp of very high growth and yet the FDI investment is happening, in that case, I believe that the growth may not grow at the same rate and there may be an impact in terms of further growth. So it may actually lead to a negative inflation whereby the individuals or the population may think that since more and more investment is coming in, should I wait for the prices to reduce and should I reduce my spending, which may lead to a glut and reduction in production. So there has to be a balance between the target, between geopolitical and between short-term and long-term investments.
Yeah. Now, thank you very much, Apurva. And Madan, very specifically on this point, a lot of the big pools of global capital are very conservative pools. You look at pension funds, you look at insurance. These are all pools of capital that are far more concerned about risk than they're concerned about return, as we see in the kind of profiles that some of the big pension funds or insurance funds actually offer in terms of return on investment. Especially for these pools of capital, which are going to be required for big ticket investments, whether in infrastructure, whether in large industrials, with all the global uncertainty. So I was being a little facetious when I talked about capital as a weapon, but more from an uncertainty and a risk and a geopolitical risk perspective. Do you see these pools of money moving as freely as they were, let's say, in the 2005 to 2020 period?
In fact, Gopal, I would look at foreign funds as actually being a weapon, like what you mentioned earlier, because I think the way in which the dynamics of politics has changed in the last few years is that if country A doesn't like country B, it's not going to be an invasion of one country on the other, but it's going to be through the economic mode, which means that it could be any kind of these sanctions that we have seen today, for example, which have been imposed on Russia. Now, I would say that this is something which is going to be the future, because I don't think countries are going to invest in warfare of other countries to protect other countries. But I think the tool which is going to be used will be economic sanctions. When I talk of economic sanctions, it will be coming in the way of the flow of funds, because if a country like the United States is going to advise companies, American companies, that you should not be investing in country A or in country B, then I think there is going to be a fundamental change in the way in which these investment flows behave. I think earlier what Apurva was saying is absolutely right, that you look at where the opportunities are. So India was one of the most attractive economies for the simple reason that there was a lot of lacunae in terms of infrastructure, in terms of the large population which had to be satiated with various goods. So therefore, it made a lot of sense for people to invest in India. And they will probably continue investing in India until this full potential is achieved. But I think the fear which is there going ahead is that in case politics actually takes over pure economic decisions which are being taken by economic agents, then we have a problem. Because if countries are going to take a position saying that if we do not take a stance against, say, Russia, countries supporting, not being against Russia would naturally be probably face some kind of threat of isolation from the Western world, then there could be a problem in terms of the flow of foreign funds. So I think this is the critical factor, because when today you're talking of, say, pension funds who are looking to invest outside, they will actually seriously evaluate not just countries, let's say rogue nations, which are defined today, like say something like Russia, or probably what you mentioned about China, but also there are these transitive relations which are there, that if you're not going to condemn Russia, you also get condemned. That has not happened today, but one doesn't know if that happens tomorrow. So as an investor, I may think twice about where I should be investing, because I have a plethora of investment opportunities today. India is one of them. So at times one may feel that one will have to tread carefully out here. We cannot take things for granted, but just saying I have the most conducive policies for foreign investors, I'm opening my doors, and therefore I can take foreign investment for granted. There could be these politically driven factors which could come in the way going forward.
Fantastic. Thanks for that. And just staying with you, Madan, you talked about investment flows. I think one of the concerns that we are seeing and hearing a lot is that we are entering a period of inflation. We are entering a fairly significant inflationary period. And in fact, there has been some commentary that the real inflation on the ground is actually probably more than what we're seeing published or what we're seeing reported. Because the basket itself hasn't changed. The basket which is used to measure inflation hasn't changed in many years. And we still are looking at some fairly last generation measures for computing inflation. Having said that, in a growth economy, obviously, if we enter into hyperinflation like in Argentina or other countries, then we do have problems. But how bad is a slightly higher inflation rate?
From the point of view of investment, I think it may not be very serious. The reason I say is that, let's assume today officially we have an inflation of 6%. And let's, for the purpose of argument, say that maybe originally it could be 7 or 8% because it's being underreported, or the way in which the index is defined. If you look at the comparable numbers of other countries, I don't think we are very much off the target. And I'm quite sure that almost all countries have inflation indices which have similar kind of problems of being dated. Okay, I'm not quite sure how it holds for all the countries, but definitely there is a case of saying we have a base year. You normally don't change the base year once too often. You do it maybe in a decade or so, something which also India is working upon. But more importantly, I think as an investor, do I actually get deterred by inflation of 6% or 8% or 10%? The answer will actually be no. I think what you have rightly pointed out, if I'm talking of countries like Argentina or some of the other Latin American countries, which have at times have had inflation in the region of 50%, maybe 100%, I think that is something which is very much disturbing. And today one is aware of the fact that most of the inflation which is being caused is more global in nature. And it's not something which is specific to India. In fact, if you look at India's recent economic history, we are still ranging around 4 to 5%, which I think is fairly tolerable. So I do not think that the current inflation which we are seeing in the country being either understated or whatever the actual number is, would really come in the way of an investor purely from the point of view of making a decision. But I think it's still go by saying what are the opportunities which are there, what are the returns which I'm likely to get in India, and they still look very, very, very much bright. And I think to the credit of the government, I think a lot has been done in terms of facilitative policies, right up to the extent of insolvency resolution, which I thought was a major cog which was there. So lots of reforms have been undertaken, very positive reforms which have started working. So I think these will be probably be the more overwhelming factors rather than a number like the inflation.
If I were to kind of paraphrase, and correct me if I haven't got this right, what I'm hearing you saying is at the current numbers, let's say 6, if it's really 7, 8%, at these current inflation numbers, it's actually not such a bad thing for India. It is comparable to many economies that are competitive to us from an inflow perspective. But adding to that, but is it going to actually be beneficial? Are we going to see also because if I look at the interest rate today, it's about the same as what the inflation rate is. So the real cost of money is 0. Banks have significantly cleared out their balance sheets. There is a lot more capital available today. And we're already hearing a lot of corporates getting onto the borrowing bandwagon again. I think one of the challenges for growth in the last 5 years has been that there's not been a lot of velocity of money flow. Yes, it's been there in some of the growth sectors, it's been there in some of the tech sectors, but in core industrials, core infrastructure, we haven't seen a lot of money flows. There's been no velocity of money. But now with real cost of money approaching 0, do you actually see this as being beneficial in the short to medium term?
In terms of the borrowing cost, the real borrowing cost definitely would be beneficial. But assuming that interest rates will be rising in India, how many times will the RBI increase the repo rate is could be a matter of debate. But we do believe that maybe 50 basis points minimum could go up to maybe 100 basis points, depending upon the course of inflation, how permanent is this number of 6 or 8% which we are talking of. cost of funding is still relatively low in India, and I think that would probably work to our advantage. But the kind of difference which we are seeing today may not be something which will last forever, because there would be a tendency for inflation to come down and the nominal interest rates to also increase. So the kind of benefit, the larger benefit which we're getting today, when investment conditions were not that good, and today we're talking of where investment conditions look good, the opportunities look good, better capacity utilization in industry, which means that lots of companies are going to start investing money. I think there would be definitely a case of less of the advantage that we had earlier, but definitely something, the interest rate structure is definitely congenial for more investment.
Great. And moving to you, Apurva, on this, any comments, thoughts? I'm not going to ask the questions again, but I'd love to hear your perspectives from a very different geographical point.
Sure. So a couple of points from my side. I think current CPI inflation is at 6.95%, right? And the finance minister had said that it's still not so bad, but of course it's outside the band of 2 to 6% that RBI or the finance ministry had stipulated. I think, from an overall standpoint, yes, inflation and growth are at times inversely focused. And RBI has actually made a stand now in the last MPA meeting that they're going to focus on inflation rather than growth. Till now, of course, they were focusing on growth. But I think we need to keep inflation under control, because the uncertainty that has come in is because of the Ukraine-Russia war and impact on oil prices and commodity prices. That was not factored in, and that is very recent, starting from middle of February. So that uncertainty has to be addressed, because to your point, Gopal, if you are looking at real inflation, maybe it may be somewhere north of 10%. But even if you go by 6.95% and you look at what the RBI has said in the last meeting, I believe personally that RBI will do something pretty soon to curb this, to curb the inflation, and probably, and just my personal view, probably increase the rates, because there may be a benefit. If you look at inflation, which is close to 7% now, it's very similar to US inflation, whereas our rate, central bank rate, is 4% as compared to 0.25% as of now in the US. So actually, it makes a lot of sense to invest into India from that standpoint, right? But we are not seeing that kind of capital market investments coming in. But there is a possibility that if this kind of situation remains and our interest rates may go up further, then yes, there's a possibility that that may actually accelerate the investments coming into India.
Yeah, because I'm taking this back to the days of the mid-2000s. 2005, 2007, where money literally was making money for you.
Yeah.
Till a lot of the exchange controls and banking controls came to literally it was free money, and we could. So, while not really alluding to that kind of investment, which is more opportunistic. The same question that I asked Madan, do you believe that we could actually see capital flows into India, more capital flows into India over the next 12 to 18 months, given the inflationary situation and the cost of capital?
So actually, I would not be looking too much. Suppose I keep the inflation factor aside for the time being.
Yeah.
Are we going to see more FDI? Are we going to see more FPI? So let's break it up into two parts. In my view, I think as far as FDI is concerned, I think it would continue in the normal pace. So what we were getting something in the region of new equity flows in the region of 60, 65, and the reinvested earnings, we're getting something in the region of around $80 billion. I think that kind of a number will probably continue, because these are investors who are focused more on the long term rather than on the immediate term. However, in terms of FPI, I think there could be issues out here, because this is where I feel that the interest rates become important. Because if I'm looking at typically at your debt investors, they would be looking at comparable returns in other countries, and the fact that India hasn't increased the interest rates, and the US has definitely spoken about tightening, which means that better returns in the Western economies compared to emerging markets like India. FPI flows into the debt segment could definitely be still in the negative territory. They could be outflows rather than inflows. In terms of equity, I think it will probably continue to be whimsical because I think almost all the equity markets seem to be moving almost in tandem. So I think when you're looking at what's happening on the NYSE and what happens on the BSE or the NSE, I think there is a lot of strong correlation. And I think it will continue to be volatile. Now, will we get 15, 20, $30 billion into equities? The answer is probably not, because again, it will depend upon the alternative markets as to how well they are doing and what happens to the currency, how stable is the currency, because that's going to be another factor which would come into play. And overall growth, of course, if you're looking at the potential of companies in India, I think if you look at the larger companies, at least the large cap segment so far, so-called large cap segment, I think they may probably be already having one of the best PE ratios. So there may be more concentration on the mid cap or the small cap companies, but that would be to a very limited extent. So on the whole, I think FDI will continue its normal pace where there's a long-term view which is taken. In terms of FPI debt, I still expect it to be negative until such point of time that the RBI actually brings about more aggressive increases in interest rates, which gives better returns to investors. And equities will continue to be fairly whimsical. And if at all we do get these kind of funds in good quantities, it could be more at the mid cap and small cap.
I'll probably add in there in terms of two parts again. I think we need to segregate what is being done in India and what is the external forces on which we have no control. So if we focus only on India, okay, because external forces, I think pandemic is nearly over. And the impact of the war, I think we will have it one way or the other within probably a few weeks' time. I think it is overly extended already. So if I focus only on India and if I look at next 3 years, okay. Now, first and foremost, we are looking at per capita income, which is at a very good level now at around $2,000. I think that is a tipping point when the middle class really starts investing and spending money. I mean, lots of households will have their first car, they will have their first refrigerator, they will have their first air conditioner. And I'm talking about the masses. I'm not talking of tier 1 cities. I'm talking of tier 2, tier 3, tier 4 cities. So I believe that growth is going to explode in the next 3 to 5 years in India, okay, in terms of spending, in terms of people's lifestyle, in terms of, obviously, digitalization is what we have seen. And if you look at the number of unicorns, India has got is the third largest creator of unicorns now. There are 80 plus unicorns in India, which in itself are valued at more than $270 billion US. So this is only going to grow by 2025. I believe that there will be more than 100 unicorns just out of India. So one is that in terms of growth of India, in terms of technology. And then if you look at what the government has done in terms of, say, ease of doing business, India has skyrocketed and improved its ranking by more than 60 ranks over the last 3 years. I think last is India is 63 something in terms of global ease of doing business, whereas it was 120 or 130 3 years ago. Apart from that, if you look at infrastructure, you look at transparency, it has only improved. And now there is a talk of full convertibility of rupee, which is now partially convertible. So if we are looking at put all these things together and we look at 3 to 5 years timeline horizon, I mean, I don't see a reason, apart from, of course, external factors, geopolitical risks, what happens to Russia, what happens to commodity. But if I purely focus on what is happening in India, I think India is ripe for all these investments to come in.
That segues me into two specific questions, and I'm actually going to flip the order. And I think Apurva absolutely believe in the India growth story. And in fact, we've been looking at this for a while now. And at Bain, our belief is that India is going to finally move from a pyramid structure of the economic demographic of the population to a pentagon. And by 2028 to 2030, for the first time ever since independence, we're going to have more middle and upper middle class households than lower class households. Yeah. So overall, the crest of the wave is rising and the shape of the wave is changing. And this is exactly what happened in China 15 years ago.
Absolutely.
What started the growth in China was the movement from a pyramid to a pentagon. And for a variety of reasons, and I don't think we have the time to get into that here, but India is on that journey. We're very clearly on that journey. And we are seeing the growth in middle and upper middle class households and lower middle class households is way faster than, and there's actually degrowth in lower class households now. The phenomena has already started. So that brings me to a question that I'd love to hear perspectives on. How important actually is global capital for India? Unlike the China model, which China was an export-driven growth model. It basically became the manufacturer for the world. India is never going to be that. Right? We will have distinctive advantage in a few sectors. There are others where we won't. But India, even if we look at trade flows, if we look at any economic flows, India's always been a domestically oriented growth economy. Consumption growth, economic growth, GDP growth has come from domestic growth. It's not come from just exporting to the world. Now, in that context, how critical really is global capital? And will we at some point be able to utilize it when we get it, but continue to grow when it becomes constrained? And that's the question to both of you, Apurva and Madan.
Okay, Madan, let me go first on that. And I would say that, Gopal, there's no right answer and there is no wrong answer either. Is it important? I would say, yes, it is important, but can it be beneficial as well as can it be a challenge? I think it can be both. We have to look at it like the usage of a knife. If you use it properly, it will be to your advantage, but of course it can hurt you as well. So the way I look at it is that for us to accelerate the growth, we would definitely need foreign capital, primarily in areas which is long-term. You see in terms of infrastructure, in terms of manufacturing, and government has done a lot again in terms of making the automatic investment ready. What will help in terms of accelerating that is improving the transparency, improving the ease of doing business. But yes, it is important for acceleration. It is important for acceleration. Apart from money, investors also bring in only focused in which actively done, but why really if someone has already worked on it? So, but we should not be reliant on it, because the risk of being reliant on it is that come another geopolitical situation or another global crisis, the countries or the institutions or the funds or the pension funds which have invested, they will be the first one to extract the money. So if we are more dependent on them, the extraction of those funds is going to lead to a huge situation in terms of our currency devaluation, in terms of our financial planning, and in terms of overall inflation, which is definitely avoidable. So it is a fine balance, and I would rely on the expertise of our economists and our regulators to make sure that we are able to be as close to the fine balance as possible.
Thanks for that, Apurva. Madan, your perspectives on this?
Yeah, so let's look at it that today we are talking a lot about the $5 trillion economy. So let me just say that let's assume an exchange rate of 80 rupees to a dollar. So we're talking of an economy of the size of, say, 400 lakh crores. Okay. We're talking of a total amount of investment which is required. I'm taking a conservative number of around 30%, which means I require around 120 lakh crores. Now, let's look at the amount of foreign direct investment which we could probably get at a reasonable level, maybe $100 billion. So $100 billion would mean something like 8 lakh crores, maybe 100, 110, 120. I'm seeing that probably able to get around 10 lakh crores out of this 120 lakh crores we're talking of. So to my mind, I think when we're talking of foreign investment, it will be a very good supplement to have. But on its own, it will not be able to push forward the overall investment cycle in India. It'll have to come from domestic resources, for which I do have to depend upon the banking system, because we don't really have that kind of a sophisticated corporate bond market. Of course, we have the ECB channel, which has been used fairly effectively as long as interest rate differential was favorable for us. But even out here, we've been getting something in the region of around $35 billion at the best of times. So I think when we're looking in terms of foreign funds, it will definitely be something which will be useful and can plug the gap, provided we're able to reach that kind of a potential of investment. So here actually, Gopal, I have a slightly different view from the rather optimistic picture which you and both Apurva have painted about the future of the economy and how shining it's going to be and how the consumption class is going to increase. I think this consumption story is something which we have been talking of for quite some time, and even before the pandemic came. I think one of the fundamental reasons as to why we did not see too much of investment is because we have excess capacity. We have excess capacity because we don't have enough money being spent. So consumption expenditure has been very much lackluster. And that's one of the reasons for this, of course, is my belief is that A, jobs have not been created. B, the level of equality has not been, the level of inequality has actually still been fairly distinct. Meaning thereby that we've still not seen the people at the lower income groups actually having the wherewithal to kind of push into the consumption stream. And most of the money is actually being spent on necessities. And on the issue which we spoke of inflation, considering that we continue with high inflation this year, I think that erodes the purchasing power to a very large extent. So my optimism for this kind of future growth of a more egalitarian or a more broad-based spending coming from within the economy. And I think this is something which even the FMN mentioned, saying that we're hoping that consumption picks up. Because investment has gone through because government is spending, maybe the private sector will enter with a lag. But I think ultimately we need to see consumption going up. That's when your investment will pick up. That's when we'll face these conundrums of saying that, look, do I have the funding capability? Will the foreign investment, will the ECB channels, will they really help me out? I think if this kind of a scenario picks up, yes, these foreign funds will be very useful. But the fundamental thing is that domestic requirement, the demand for investment should be more buoyant than what it's today.
So if I were to kind of paraphrase what you're saying again, Madan, the core thesis of India moving from a pyramid to a pentagon is something that you believe is not happening or not happening at a fast enough pace. And it is only that, I mean, I think what we're all agreed on is that's going to create the virtuous cycle of growth. I think what we have different points of view on is when that is actually going to happen. But if and when it does start happening, that spend cycle itself could significantly contribute to the kind of investment that we require for further growth.
Yeah, I actually don't want to deviate too much, Gopal, because the issue again is that are we creating enough jobs? I think there's always this controversy about whether employment is going up, unemployment coming up, down, CMI, EPFO. But fundamentally, I think for this structure to change, we need to have more jobs created so that people have the spending power, which to my mind is not happening at the right pace.
Okay. And let's hold that conversation for another day. Which again, it's a rich conversation which is going to take time. But maybe if I could get back to the theme that we were talking of before this question about foreign investment, specifically into equities. And one of the comments that I've been hearing quite consistently over the last, I would say many quarters, is that most FIIs are net negative in India now. So while there are occasional positive flows, on a net basis, they've been negative. The reason that the markets have not reacted adversely is because of the strength of SIPs and the volumes of individual investors who are actually getting into the market. And there's just a lot of liquidity that's flowing in, also because there are not a lot of other channels to spend on. My question is not so much about the flows, about what's happening on the individual investor side, but what are the one or two things that you would suggest, each of you would suggest, to bring back FII confidence that are within our realm of control? Clearly, there are global factors that are outside our realm of control, but are there things in our realm of control that we can do that can help bring foreign institutional investors back in a big way and make these net flows positive again? And Madan, this time I'd like to start with you.
No, actually, this time I don't have an answer because I don't think it is, when a decision is taken on equities, it's more based on their own perceptions about how the market is priced. and what are the future earnings which are going to come through. So it's run a lot on the basis of fundamentals. I don't think there are any institutional impediments which are there, serious impediments which are there. I think we had this issue of taxation and all that, which is where it is. But I think when you're talking of FDI, it's possible to have more congenial policies. One can actually suggest what has to be done, if at all there are lacunae there. But when it comes to equities, I think it's purely the case of the fund manager taking a decision about how attractive the market are, what are the comparable returns in other markets. So I think this is something which will remain an unknown to us. It's an exogenous factor. And I don't think there's anything that we could actually do to make sure that there are greater flows coming into the equity segment. Because there are not people here with commitment for a long time. They're looking where money can be made.
Okay. And Apurva?
Well, I partially agree with that, because the thing is that apart from, I don't think this outflow has happened because of anything fundamentally wrong with our markets. I think it has been because of factors which are outside of India. Just like you have seen factors, I mean, it's nothing as impactful as what we are seeing in China, as an example. So lots of investment is leaving China, which was in stocks because of various policies or policy changes that are happening. None of that is the case in India. And you have made a very valid point, Gopal, that the retail investors and SIP has come in to soften that blow, which would have otherwise impacted our markets in terms of the funds movement or the funds that are leaving the stock market. But again, if you tie it in with the growth story, if you tie it in with the middle class, if you tie it in with the Pentagon shape, if you tie it in with the valuation of our companies, if you look at the valuation of the market and you tie it with the full convertibility of the rupee, I think these flows have to come back. You can't ignore a market and a growth like India and the stability of the companies and the growing middle class. I would say that partially agree with Madan that it will depend on our own growth, but the reduction that has happened has nothing to do with our growth. It has to do with the challenges that they are facing in their own markets.
Interesting. I think on this one, I would actually tend to agree that while there are many naturally attractive factors about India, and it's surprising that flows are the way they are. Only time will tell on whether or not we are going to be a preferred destination for global equity capital coming into equity markets. I think the one element that we'll probably need to be a little cognizant here is the depth of the Indian market. So while we keep talking of the small and mid caps and the large caps, and it's a challenge that even some of the mutual funds are facing, which is what is the next set of equity stocks that they can put money into? Because one of the issues is that there's just too much competition for the good stocks. And that has been one of the reasons to drive pricing up. So the faster we get to more depth in the markets with a lot more exciting investment opportunities in the equities market, I think the better it's going to be for some of these flows to start coming back. We are going to be running out of time soon. So I'd like to conclude the session by asking each of you, and Madan, you already alluded to it, so I will formally ask you the question. If you had to do three things that would help FDI, not equity type, not FII, but real FDI into hard investment assets on the ground, if there were two or three things that would be on your wish list, basis which you think a lot more FDI could come in, what would those be?
So one is that we need to have more clarity or some kind of protection which is provided to investors whenever it comes to, say, natural resources. Now, why I say natural resources is that we have seen that typically if you look at FDI, they go to areas which are not regulated, where they don't want to have regulatory issues coming up time and again. So I think that is one thing which I'm not quite sure about what specifically can be done for which sectors, but I think given the fact that they have tended to shy away from any sector, wherever there has been government interference. Government policies could be changed at any point of time. So I think this absence of clarity on policies have kept them away from one particular segment. So I think that is something which needs to be relooked at, so that because those are areas which require large amounts of investment. And in case we're able to provide the right kind of an environment, we could be seeing larger flows of funds coming on. I think that would be the main thing which I would be interested in seeing.
Okay. Anything else from a taxation, from a convertibility?
No, I think convertibility already exists for foreign investors. It's full convertibility is there for them. And taxation, I'm not too much of, I don't think I have to, I'm not too much of an expert to talk on taxation. So I'd rather not talk on it.
Okay. And Apurva, your views on this?
My view is, in addition to what Madan has said, I would say that we need to create more revenues for ESG investments. So sustainability is a very, very important aspect, and the recognition is increasing more and more. So considering the size of our country, considering the population, considering the economy, considering the growth, we have to create more and more opportunities for other funds, other pension funds, governments, large corporations to invest into ESG. We need to create opportunities that they can invest into ESG solutions in India. That is, I think, renewable energy, diversity, reduction of carbon, etc. That is very, very important. The second part is we need to continue the good work that is happening in terms of transparency of policies and ease of doing business. Yes, we have done a lot, but we are still 63rd in global ranking. Why? What will it take for us to be in top 10? What will it take for us to be in top 20? I think it is not there's not a ready answer, but we need to strive to do that. I'll give you a simple example. I came to Singapore, moved here. I could register my company, open the bank account, everything I could do online without having to meet the person. And I could check my company, get the company UEN number, discuss with everybody, and register a company in a very credible jurisdiction within a day. So what will it take for us to get there? I think that is something, it is not a one-stop shop right now. We have to go through multiple iterations, but I think that is the end goal that we should look at.
Fantastic. Any closing comments from either of you that I may not have touched upon that is top of mind when it comes to the opportunities and challenges of capital flows into India?
See, on the whole, I think that we need to look at foreign capital flows more seriously, simply because besides providing us funds from the point of view of the market or from the point of view of overall investment, we've seen that for a country like India, which would normally be in a perennial current account deficit, we get a lot of support which comes from the capital flows, especially through both the FDI and FPI route. So as an economist, I feel that we need to do everything in order to make sure that that we have a facilitative environment so that these funds come in. Because at the end of it, I think the whole business of self-interest works. They come in for self-interest in order to promote their own profits or whatever their interests are in India. But this helps the country also grow at a faster rate. And given the fact that theoretically, there are no limits on the amount of funds which could be coming through this foreign route, that is both FDI as well as FPI, I think we need to be very nuanced in our policies and our overall approach. And we should be more welcoming so that it actually becomes mutually beneficial for both India as well as for the investors.
Fantastic. Apurva, any closing thoughts?
Yeah, I would say that, yes, absolutely. We need to look at it as partnership. We should not be looking at it as a competition. We should be looking at it as partnership, because at the end of the day, we also need to be selfish and see that how is it going to benefit us. And at the end of the day, we need to ensure that we reduce the friction that is there in terms of policies, in terms of taxation, in terms of rupee compatibility, in terms of IP rights, in terms of transparency. I mean, we need to reduce the friction so that we ensure that the funds flow in smoothly. It is transparent to all the investors that where they are putting in the money. We are encouraging intelligence coming in. We are safeguarding their IP. I think those are some of the challenges with which the investors faced earlier when they invested into China. And we have to learn from that and ensure that we give an opportunity that we learn from those mistakes and don't commit them. Yeah.
Fantastic. Thank you both. Really appreciate you both taking the time and contributing to a very rich discussion on a topic that I'm sure we haven't heard the last of.
Sure.
And really appreciate your time and thank you very much.
Thanks.
Thanks, Madan. Thank you.
Bye-bye.
Bye-bye. Thank you so much for tuning into ET India Inc Boardroom and stay tuned for more.